Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Another week gone by in the summertime. Man, this one's going fast. Unbelievably fast, actually. The reminds me that we've got another seminar coming up. It looks like, hang on a second. I forgot what the date was. So I have to go to Bullington Capital online and check under the seminars. And it's actually Thursday, October 6th. So that's sooner than you might think. It's about 8 weeks out. We're going to do this one a little bit differently. We're going to start early at 6:30. We're going to have a special session. I'm calling it Stock Talk. I used to do this a lot on the radio. But by that time, actually this time, we're going to do 45 minutes of just talking about individual stocks and looking at things like sales, profit margins. How do you determine what a stock should sell for, or what a normal price on a normal company would be under normal conditions? That's what we're looking for. And because I haven't been doing that a lot on the radio, I'm going to do it in this seminar. We're going to go 45 minutes. We're going to take a 15-minute break, and then the actual seminar will begin. And we're going to look at the couple of momentum strategies that I use in my practice. They're my two favorite. One of them involves exchange-traded funds. The other involves small and mid-cap stocks. So, and these should be a part of just about every portfolio, because in their categories, if you compare them to their appropriate benchmarks, like the small and mid-cap, you can compare that to, the Russell 2000. So actually I had a better long-term track record. And that's one of the reasons I use it. But more importantly, one of the reasons I use it is it has a tendency to recover more quickly from a decline than the Russell 2000 has over time, or at least I should say it has had a track record of doing that. We're not allowed to make promises for anything in any types of returns or guaranteed on principal, unless it's a government bond. But that's another story. And I did want to mention at the last workshop, we talked a little bit about doing bond ladders. And it was interesting. I got a really negative response from a couple people because the interest rates were so low. And that's my point. That's my point on the radio show for so long is that, if you want guarantees from a government agency or the federal government itself, the rate of return that you're looking at is extremely low. But that money is there because it's guaranteed. It's not there because it's got the potential to give a huge return. It's there for safety. And it should be a part of everybody's strategy. I think I have about 15% of my own money, I'm pretty sure I do, into some sort of a government bond fund. Or even cash that's FDIC insured. It's about 15%. I have some other money in high-yield bonds, so I have about 20% overall that's invested in fixed income. And that's me. I'm pretty aggressive, but I'm very confident. I'm very confident that the dividend-based strategies I'm using are going to do well. I'm very confident that the momentum strategies I'm using will do well. And I know they'll do well at different times, and I'm patient. So I will, and by the way, you're listening to a guy who had very little patience. And if you listen to the tone of my voice, it sounds like I still don't have much patience. But I will tell you, my behavior when it comes to my money is different than my voice sounds on the radio or in a seminar, or if you're one of my kids or anybody that knows me for that matter. But I've learned to become patient, and that's a very difficult lesson to learn for an awful lot of people. And I'm telling you, you can do it. If you put your mind to it, you can do anything you think you can. And but you got to have patience, even with the very best strategies in the world, you still have to have patience, because the best strategies, and those when I say best, what I mean is I'm actually translating for the general public. When I say the best, the general public thinks I mean the ones that make the most money. And for the most part, that's true. The ones that make the most money would be best, but it's not entirely true. The best strategies give you the best return given a certain amount of risk that they're taking. There are a lot of strategies that have good returns, but have too much risk. And when you see your portfolio decline by 50 or 60%, and you bail because you think it's going all the way to zero, and then it rebounds, and you miss that big rebound, what good is it to have access to a strategy like that if you're not prepared to handle the risk? It does you no good at all. And I know that the first reaction that 9 out of 10 unsophisticated investors have when I say something like that is, well, why don't you just get out when it's near its top, and then when it bottoms out, buy it back again? In fact, I had a guy at a seminar, and this was kind of funny. He only came to one seminar, and he was brought there by a friend. So his friend is sitting next to him, and he's sitting there and he's listening. And and I was talking about an individual stock, and there are certain patterns that show up occasionally. And by the way, the very best patterns, they only work 50% of the time. How do you make money on that? By cutting your losses. That's how you make money on that. You only need to win on 1 out of 2. 1 out of 2 is phenomenal. Actually, those are the best patterns. They win. You know, a lot of people say, well, you might as well toss a quarter. Well, if you're not going to cut your losses, yeah, you might as well toss a quarter. But if you cut your losses and you keep your losses at least somewhat lower than what your gains are, so let's say you decide to take a 10% loss, make sure you go for at least a 15% gain. That way, if you're right 50% of the time, you're still profitable. You know, I'm going to let you stew on that, and I'm going to let you think about that. And I'm going to tell you, you can go to iTunes to listen to this online. You can go to my website, and iTunes. You can download this. So if you didn't get what I just said, go back and play it back and listen to it again. It's there now. I no longer have to keep repeating myself. You can go and look this up online. It's on my website, Bullington Capital, so you can download it there. You can go to iTunes. It's there. We're on iHeartRadio now, which is kind of cool. Just search Bullington Capital. So when you hear this stuff, you can go back and you can access it. So, and slowly but surely, we're putting the text together. Everybody that came to the last seminar that's a client that wanted the access to the ebook that I'm doing with the results on the high dividend model over the past 10 years, quarter by quarter, and an explanation of what that is, that's going to be done on Tuesday. You will be receiving that by Tuesday. So glad to get that out of my hair. Writing is brutal. It's a lot easier to talk. I remember talking to my baby, my youngest daughter, and I was asking her about reading books, and she goes, I think she was about 7 or 8. Reading books is a lot like going to a movie, Dad, except the movie's much faster. And I had to agree. So if you don't like to read a lot, you'll like these ebooks, by the way, because they are super short. Just the answers and a brief explanation and a point in the direction of further research, so you're not wasting your time. And that's pretty good. So anyway, that is going out. We were talking about. I've just talked in a complete circle this past 15 minutes. If you have a question, by the way, and I'm sure I probably invoke lots of questions and people forget about it because I talk too fast and change the topics too quickly. I forget about it myself. But you can feel free to call us at 216-901-0945, 216-901-0945. You can always email me, bill@bullingtoncapital.com. You can go to my website and make an inquiry there. And we're just talking a little bit about what we talked about at the last seminar, the bond ladder thing. And this is how I would use that, incidentally. This is how I'd use a bond ladder. A bond ladder, for those of you that don't know, is just a schedule of maturities. Say you're going to buy a CD or a bond that matures next year. and then one that matures 2 years from now, 3 years from now, 4 years from now, 5 years from now. Why would you want to do that? Because a 5-year CD pays more than a 1-year CD does. And you're trying to guarantee an income stream. You're trying to guarantee income. This is primarily for people who are retiring or nearing retirement and are going to have to start withdrawing from their money. So it's a concept whereby you're going to try to guarantee the money that you are going to spend over a fixed time period. And you earn the best interest rate you can, given the risk that you're taking and the length of time you're willing to tie the money up for. And I've got a question here. Does the caller not want to come on the air, by the way? Okay. So somebody doesn't want to come on the air, and he wants. I can't understand the question here. Is he asking about the fixed income? Okay. All right. So we got a caller asking about fixed income annuity. Fixed income annuities are guarantees by insurance companies. So the guarantee is only as strong as the insurance company. If that insurance company goes belly up, the way AIG did, remember that? The guarantee is going to be renegotiated. In most cases, you'll end up getting less money than you thought you were going to get. Okay, so that's the first point I'd like to make. Second point is the fixed annuities, the vast majority of them from the high-quality companies, those companies who are not in danger of having to go back, file a bankruptcy, and renegotiate. And a lot of insurance companies don't technically file bankruptcy. The state insurance departments from multiple states will come in, seize the assets, and sell them off to other insurance companies. And that's what happened. The other insurance company comes and looks at the contracts and says, okay, well, I know this is what they promised you, but this is what we're going to promise you, so you can take it or leave it. If you leave it, you're going to end up losing some money. So a fixed, and there might have been another question about an indexed annuity. An indexed annuity is not a good idea in most cases. The vast majority of them are too expensive. You don't see the expenses. We can show you that. In fact, that kind of fast forwards me through to one of the other topics I was going to talk about this morning, and that is looking at annuities. If you have annuities, there are two relatively new, they've been around for several years, two relatively new products out on the marketplace that have extremely low cost ratios or expense ratios. Extremely low expenses. One of them charges 0.25%, that's 0.25% on top of your mutual fund fees. Which are discounted, by the way, because those are institutional funds. And the other one charges $20 a month no matter how much money you have. So, in other words, if you only had $50,000 in an annuity, the 0.25% annuity is probably the better idea. If you have a couple $100,000, then the $20 a month would be the better idea. It would actually be less expensive. They both have access to a tremendous number of mutual funds within the annuity. Basically, it works kind of like a non-deductible IRA, but it's actually got some other benefits in addition to the tax deferral. You can put more than $5,500 into it, which you're actually limited on a non-deductible IRA. You're not limited with one of these products, and it can do a lot to reduce the taxable income that you're or the income that you're paying taxes on if you've got a lot of investments that aren't in IRAs or other qualified plans. So there are some really good ideas out there. Now, not all annuities are created equal. In fact, there are a huge number and types of annuities. There are actually a few thousand. There are almost as many types of annuities as there are mutual funds. So you really have to go in and look to see what you have. And if you have old annuity contracts and maybe you're dissatisfied with them, one of the services that we'll provide at Bullington Capital, you can send us a copy of your most recent statement, and we'll break it down for you and we'll explain it to you. Maybe you don't understand it. That happens all the time. Or maybe you've forgotten. It's been so long since you've looked at it, you don't remember. The annuity analysis service is free. We'll explain the product to you. And if it's a good product, I'm going to let you know. This is a good product. You should probably keep it. If you can do better, I'll let you know. And the decision is up to you. So it's your choice. Yeah, but many cases in an older annuity that's been around for a while, Maybe it's got a death benefit or a living benefit. In many cases, you can actually retain those extra benefits, but move or transfer a big portion of the money to a much lower cost product. So you're actually earning a higher return on your cash and not giving up your benefits. Now, that's not the death benefit and the living benefits. That's not always possible. That is not always possible, which is why we have to take a look at it. So, but if you've got an old annuity contract out there and you've been wondering what to do with it, or you're a little frustrated with it, feel free to shoot us a copy of it. You can scan it and send it to us electronically. You can, call us. We'll send you a return reply envelope. We'll take a look at that and give you an idea of what we think. And we're always unbiased. We are, as a registered investment advisory firm, it's actually the law now, and it has been for us for an extremely long time, to work in your best interests. We're known as fiduciaries. We have to work in your best interests. So we don't get paid commission at my firm. It's all based on the assets that we manage. Anyway, got to take a real quick call. You can call us 216-901-0945 if you'd like to. I've got Don in Fairview Park. You have a question there, Don?
Yes, I was wondering how I could get a little more information on these annuities that you speak highly of.
Well, you can actually call me or email me in the office, and we'll be glad to send you out a packet to take a look at it. One of the companies is it's an insurance company that's owned by Fidelity Investments. They started the insurance company just to do annuities, and it only offers tax deferral and low cost. That's the primary benefit. And they started it particularly for that reason, because they know a lot of people have mutual funds that aren't in an IRA, and they don't like paying taxes on the capital gains or dividend. Or if they switch from one fund to another fund in the same fund family, that's still treated as a sale and a purchase by the IRS, and you have to pay tax on it. If that happens inside of an annuity, you don't have to pay. There's no 1099. You don't start paying.
Right.
Yeah, so it's pretty good.
Well, what's your phone number at the office?
It's 330-664-0700. And if you remind me, Don, an annuity, I'll remember this conversation, and I'll get to it pretty quickly.
Okay, that's 330-664-0900?
0700.
0700.
Right.
Very good. Thanks, Bill.
Okay, thanks for calling.
You're welcome.
Bye-bye. Yeah, just a little history on annuities, especially variable annuities, those that have mutual funds in them. The variable annuity is actually safer than the guaranteed income annuities are, or the equity indexed annuities, because the variable annuity is actually, they're basically tax sheltered mutual funds. They're institutional mutual funds within an annuity product. It's like your 401k plan. So the mutual fund companies actually have custody of the assets, not the insurance company. The insurance company is just the administrator. They're getting paid to push paper around. Anyway, I hear the music. That means I got to take a real quick commercial break. You're listening to Bill Bullington right here on the Bullington Capital Report on 1420 The Answer. We'll be back after these messages. Back. So, yeah, if anybody else has questions out there, you've got an old annuity contract out there, you're interested in learning more about them, feel free to contact us. Go to bullingtoncapital.com. There's a contact us page on there. I don't have anything written on annuities on the website just yet. At some point in time, we'll be putting that up there. But, yeah, it's there's some very big benefits to that. The tax deferral is a huge issue. If you've got in fact, I just had a client last year. We're in the ETF model, and the ETF model has turnover, which means there's buying and selling. So you end up having to pay taxes as you go. If we use the annuity to do the same sort of things with, we're still using a rotational model there. We still actively manage it. You don't have to pay taxes on that because it's tax deferred. And we charge a management fee for that. It's 1%. if it's more than your 2% of your AGI, you can actually deduct that management fee. Or you can do it yourself, actually, if you want to manage your own money. You don't have to pay a management fee. So that works too. And it reduced the amount of taxable income she had to pay by a fairly significant margin. And what's really interesting with the variable annuities, see, insurance lobbyists are incredibly strong, and they get a lot of things done in Congress. They get a lot of things done a president can't get done. And anyway, so when you start to take money out of those, first of all, you can delay it forever. There's no age 70 and a half rule to taking money out of them, so you can tax defer it forever. If you do take money out, they take your life expectancy into account, and they treat a portion of what you're taking out of it as a return of principal, so it's not taxable, at least that portion of it. And the older you get, the larger they're treating it as a return of principal. So if you're older, you actually pay even less in taxes. So there's some big benefits to doing that, and I think I used to use the products when I first started using them. The expense ratios were significantly lower than they are today. They were about half. They were about half, and those products back in the day, 10, 15 years ago, they were excellent products. The problem that the insurance companies ran into with many of them was that they were guaranteeing 6%, 7%, 5% interest rates. They were guaranteeing that your principal would go up by that amount each year, with simple interest, not compound, but that's still a pretty good guarantee, especially in today's interest rate environment. And then they would guarantee an income based on that level. So whenever your money doubled, in most cases, the ones that I used that were most popular, they give you the option that when the guaranteed value was twice what you had actually put into it, that you could get a certain amount of income, which is much higher than interest rates are today, based on that higher amount, whether or not your assets had actually grown to that amount. Okay, so what's happened is a lot of the investments have not kept up with, especially the ones where people got involved and would go to cash during something like Brexit, and now missed the big rebound. So the individual investors they were still allowed to manage their portfolios, and they haven't done nearly as well as the average balance fund's done. And the average balance fund would have met those goals. So the insurance companies have had to pay out of their pockets because they didn't meet those goals, because people were involved in managing their own assets in there and didn't do as well as the guarantee. So the insurance company, they were stuck too, because they had to honor those guarantees. So what they've done is they've had to raise expenses on people that are coming into them after those time periods. So anything that's been sold in the last 5 or 6 years has had a significant increase in the expense ratios. That's the primary reason I stopped using them. The expense ratios have gotten so high that it's incredibly difficult to make a decent return. So again, if you've got some of those old contracts out there, they may be worth keeping. If you have a contract that's laden with expense ratios, we'll let you know. And I'll let you know if there's some alternatives out there that you can take a look at to reduce your costs. Because, not having to pay taxes, and incidentally, if you're in one of the upper income tax brackets where you're going to pay the surcharge, that Medicare surcharge, you may be able to reduce that tax, quite possibly even eliminate the tax by deferring your gains on your investments through a tax deferral only annuity product. That's super low expense ratio. So like I said, feel free to go to my website, give us a call. It's something that I'll be talking about in the future because it's a big deal. A tremendous number of those have been sold. A lot of people are buying them. They continue to sell them. The industry continued to sell them after the expense ratios had started going up exponentially, and I just couldn't see us making that money back. So I am glad to have an option now, because tax deferral is a big deal, especially if you're right on the fence. If you're right in one of those categories where if you just had $15,000 or $20,000 less of taxable income to report, that you would escape those surcharges, the surtaxes, whatever you want to call it. penalty taxes for making too much money. Yeah, it might help you. So, give us a call. We'll be glad to take a look at that. And another thing that we're going to look in the last part of today's program. I'm going to bring up some of the stocks. I told you at the next workshop, go to my website, October 6th, 6:30. We're going to have stock talk. We're going to talk about individual stocks. By that time, I'll make it a point. I'll put it out there whether I think it's ready or not. By the way, I've got a couple thousand pages written that I've never released, mainly because I'm very critical of my own work. I want to keep it as simple as possible, but and I don't want people taking it the wrong way. So I've written a lot of stuff that I've never published, and a lot of it's relatively easy. So I'm going to try to hang that up, that hang up. I'm going to hang up the hang up and go ahead and publish this stuff so that you can kind of take a look at individual companies. In the last segment of today's show, I'll talk about a couple of stocks that have come up on scans recently. And this is the kind of thing we're going to do at the Stock Talk. Because I'd talked about doing an investment club a couple of years ago. I took a polls to see who would be interested in it. And most people were interested in it until they realized how much work it was going to be. And then I didn't get much interest at all. So the most important part of the Stock Investment Club is really to be able to meet together like-minded people to discuss investment ideas and have an agenda and have checklists, things that, have it organized so you can share the information and maybe help each other out. I can't tell you how many times throughout the year somebody called me and said, hey, could you look at this for me? And I looked it up and I went, wow, that was pretty good. In fact, I think one of my last big winning stocks was that way. That was a pretty big deal. So anyway, if you are able to speak the language, it really helps you as an investor, and it's something that's kind of fun to do. And I really encourage everybody to manage a small portion of their own money. Not only do I think it's a good experience, can be a very profitable experience, but you learn and you gain an appreciation for what money managers do, for what mutual funds do, and the whole investment process, which is vitally important. And I know everybody always says everything's vitally important. Getting your cuticles done on your toenails is vitally important if you sell one of those products. The reality is your money is really important. That's the reality. So you should know how to invest because interest rates are extremely low. There's a very high probability that they're going to stay extremely low for a very long time. An extremely high probability that they stay very low. There's an extremely low probability that you see a 5 or 6% CD again anytime in the next 10 years. I'm not saying it's impossible. I'm saying that the chances are very slim that you see that happen. So now is more important than ever in the history of this country. This is the lowest interest rates they've stayed for this length of time. And it's more likely going to stay this way rather than reverting to the mean because there are certain things, certain physical impediments, namely an $11 trillion interest-bearing debt. That's a physical impediment, a physical obstacle to being able to raise interest rates, something we haven't had to deal with before. And if they raise interest rates, they're volunteering. Every 1% increase in interest rates raises the budget by $110 billion. Now, I know it's not in 1 year, and people. I'm going to get some engineers and CPAs pointing out, well, that's okay. Well, eventually, that's what happens. Eventually, if you raise interest rates when all the debt matures and refinances, you owe $110 billion more than you would today if you're not paying the debt down, which we're not doing. So it can take an extremely long time to pay down enough debt to be able to raise interest rates. And incidentally, they have to start that process, which hasn't been started yet. So, when, what's his name, Bernanke left office, one of his first speeches, interest rates are going to stay this low for 10 years or quite possibly much longer. And, we still haven't started taking the steps that we need as a country or as a government to be able to raise those interest rates. So what have you got left? You got the stock market. You have things you can put your hands on. You could start a business. That's what we all want to do when we retire, right? Go back to work. But that's reality. You can keep working. You work a little longer. Every year that you put off working, your Social Security benefit, if you're not collecting it, goes up by 8%. Is there a risk there? Yeah. What happens if you get hit by a bus and you collect nothing? Okay, so there's risk everywhere. There's risk in CDs. CDs are not paying enough interest to live on. So now you're looking at your money lasting as long as you do. How do you make that happen? Which brings me to another point. We've got some really nice software. It's a package that we just started using a few months ago. We've gotten training in it now. It's pretty easy for us to use. I really like it a lot. It gives you an idea of what the probabilities are of you running out of money doing whatever it is you're doing with your money. So we can put your portfolio in there. We can put your age in there. And we can take out the amount of money that you're spending from it each month, and it'll tell you what the probabilities are of you being able to reach those goals or live long enough or to live without outliving your money. So that's a very nice thing to be able to do for people. And it's based on all the best research out there. The people that have written the software behind this are extremely smart. The big institutions are using this more and more so all across the country. And it's a good idea. It's a very good idea. You're kind of taking the same approach that an insurance company does. What are the probabilities that I run out of money? What are the probabilities? And insurance companies don't like to take a lot of risk, incidentally. They try to, and if they're going to take the risk, they're going to charge for it. You better believe that. That's why the equity indexed annuities, the new ones, don't work out that well because their costs are so high for the insurance that they're buying on those portfolios that it doesn't leave very much for the investor. And we'll take a look at those too. But again, this software, we can put in your information. It can be very generic. It could just be your age, whether or not you have Social Security, and your assets. And then you tell us how much you want to take out, or we'll tell you how much you could potentially take out depending on what kind of portfolio you have. And by the way, it breaks down the portfolio just into stocks, bonds, and cash, which I think is an excellent idea. Stocks, bonds, and cash. Now that's, when you look at these reports, it's assuming that you're doing something logical with this stock, not that you're putting 100% of your money in your company's stock. That's not a logical thing to do. That's an extremely aggressive thing to do. And that can hurt you significantly if your company doesn't perform very well. So, again, it's assuming that you're doing something reasonable. Could be index funds, could be exchange traded funds, could be some of the strategies that we use, some strategies you come up with on your own, as long as they're relatively well diversified and logical, and they have stocks, bonds, and cash. Your portfolio probably going to match up one of the portfolios that we select. We'll try to select a portfolio that's closest to what you have and show you what the probabilities are that you will not outlive your money, which is a big one. That's a big deal. So we've been really flying through an awful lot of material and talking about a lot of stuff today. Feel free to call us if you have a call, 216-901-0945 here in the office. By the way, I just heard just a couple weeks ago, and I keep forgetting to mention this, we're on iHeartRadio, and I know I mentioned it a little bit earlier in today's show, but we're on iHeartRadio now. So if you're out and about and you're on the internet, you want to catch the show, you can actually tune into iHeartRadio and you can listen to the show, Bullington Capital Report. Just do a search for it. It'll come right up. If you missed the show completely, it is on iTunes. So the Bullington Capital Report is on iTunes now. You can go to my website and follow it there. We also host it on my website, so you can go to Bullington Capital and listen to it there if you'd like to. So if you hear something and you want to see it, by the way, the nice thing about these types of services is you can fast forward. So if I said something and you want to hear it and you missed it, you can just fast forward until you find it. Or you could actually shoot me an email if you have a question. So feel free to do that as well. And it's amazing. When I think about the modern technology, it just it blows my mind what we do today and what we take for granted. You know, I remember back in the old days, and now that I hear the music, I guess I'm going to have to hang on to that memory for a couple more minutes while we hear these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. We'll be back after these messages. And we're back. You're listening to Bill Bullington right here on 1420 The Answer, Bullington Capital Report. I'm going to go right to the phones. If you have a call, 216-901-0945. And I'm going to Doug in Parma. You have a question about Jim Dale Davidson?
Yeah. Hey, this is Doug in Parma. How you doing?
Good. How you doing?
I enjoy your show thoroughly. What you say, it makes so much common sense.
Well, thanks.
Anyway, I'm in my 70s, about mid-70s. And I come across a fella on the computer called James Dale Davison, and this fella is predicting doom and gloom. He says the national debt is $19 trillion, and no way we can service the debt. And he has several other factors. He goes through about 8 different points that he cites as. I just like to see whether you ever run across them. And he says he predicted the crash of 2008 and 1999 correctly, and this is one of the things that he sees coming. Now, if you say doom and gloom all the time, maybe you're going to get them right once in a while.
Yeah, that's typically what happens. And do you remember P.T. Barnum?
Oh, yeah, right. Yeah, one born every minute.
Absolutely. Yeah. And this
right.
Guy's trying to take advantage of that.
Yeah, he puts a newsletter out, and he wants you to sign up for it. And I'm sure there's a cost and whatnot.
Yeah, and there are an awful lot of people who just love that. They love to have the bejesus scared out of them all the time.
Yeah, I understand.
And they're addicted to it.
Yeah.
And he knows, guys like him, they know that type of individual exists out there, and in their mind, they're just fulfilling a need. That's all they're doing is fulfilling a need.
Yeah.
Because do you know what GDP was over the past 12 months?
Well, it's probably about 1%, 2%, somewhere around there.
Let me see. I'm going to actually look it up here because it's constantly changing.
Yeah.
It doesn't mean not necessarily the growth.
Yeah,
Let's see,
right.
The monthly GDP. Here we go. I've got white charts. That's one of my services. Okay. So you got the past 12 months, GDP is $18.41 trillion.
Okay.
And I got to get my calculator here because I'm going to do a little bit of math. At the end of World War II, our debt relative to our gross domestic product was 125%. Okay?
Okay.
So if we take 18 and then multiply it by 1.25,
right,
you'd need to get up about another $1.5 trillion. You'd have to add to the national debt to equal the debt relative to GDP at that time. So if you put things in perspective, we were in worse shape right after the war ended in 1945 than we are today. Now,
that makes sense.
Okay, now, every time I say that, somebody says, yeah, but we didn't have all these industries. I go, yeah, that's right. Now we have all these industries. You're saying that like it's a bad thing. I'm saying it we've got all these other jobs to pick up the slack when one thing slows down.
Yeah, right. After World War II, we were in prime shape because all the other major countries were kind of destroyed by the war, and we had our manufacturing, and we were king of the hill.
Yeah, but we also had to repay. We paid for a lot of stuff that was broken over there and we never got paid back.
Marshall Plan and everything else. Yeah, you're right.
So
you're right.
We went on one of the biggest spending sprees the United States had ever seen after we had accumulated all that debt, and nobody had a cell phone.
Into the future, right?
Nobody had a color TV.
right, into the future.
Yep.
So
And
we still have confidence. It's still looking good. You don't think the Federal Reserve holding down the interest rates? They can hold them down forever, though.
Oh yes, you look at Japan. Japan's
Mhm.
interest rates have been this low. Here's my biggest fear. Okay, my biggest fear is that stock prices right now. Stocks are fairly valued. If you take the largest 100 companies out of the S&P 500, the rest of them are underpriced.
Right. Right.
So that's a good thing. It's a good thing that the value has not been recognized yet. My biggest fear is that the S&P 500 or the Russell 3000 doubles in the next 3 or 4 years, and it definitely won't be worth what it's not going to be worth that much money.
Right.
And
right.
it will crash again if that were to happen. But the problem is everybody's going to want in at that time.
Right.
So when everybody on the planet is so happy and they want in, like they
buy
were
high. Right. Sell low. Right.
I will,
yeah, I've heard that one. Yeah.
Then I'm going to be depressed.
Well, I certainly want to thank you for your opinions. I enjoy your show. Try to listen to it every Saturday.
Oh, well, thanks.
I appreciate it, and thank you very
Well,
much.
thanks for calling. I appreciate that. Have a good weekend.
You too now. Take care.
Bye-bye. Yeah, let's see. I'm not a I don't think I'm a Pollyanna because, I look around. I see what's happening. I try to be a realist. And I don't see anything. There's nothing apparent that's completely obvious. By the time things are completely obvious, by the way, it's generally too late to do anything about it anyway. But the reality is there's nothing really that bad relative to the economy. Actually, economy's in pretty good shape. New car sales going very good. Yeah, bank loans still slow. You don't have a lot of delinquencies picking up. That's a big deal. Those two things, by the way, those two little factors, which nobody ever talks about, are the two most important. Yeah, which makes complete sense now that I've been out of school for the past 30 years and have seen how people think. And basically, by the way, it's not you. It's the media. That doesn't sell ads. You know what sells ads? Trump. He sells ads. That's what's going to get media coverage. The most important things are relatively rarely talked about. And bank loans, that's a big deal. How many loans are the banks making? When that starts to slow down, you can bet the economy's already slowed down. By the time they report those numbers, the economy's already started to slow down. Auto sales is kind of a big deal. It's not as big a deal as the delinquencies on bank loans. Everything in the world revolves around credit. It all does. Like it or not, that's the world we live in. That's reality. And that's actually doing fairly well. Not as good as it could be. Nowhere near as good as it could be. There are some other issues. And, I talked a lot about public works projects that have been funded where the funds have not been released. So they've been holding it up. And that's a big deal, but it's not as big of a deal as bank loans and delinquencies. Those are the two most important factors. And now that I've said that, looking at those and analyzing that doesn't give you a really good idea until, like I said, until the direction is clear that it's already changed. Then and by then it's typically a little bit late. Markets have already peaked because there are people that are smarter than we are that have better connections that are out there. They've got thousands of analysts scouring, talking to these people, and they are selling short significantly in advance. In fact, they will lose money for a couple of years when they realize what's happening, and they'll cash in one day when the market does slow back down again, or the stock market goes down, because credit conditions dry up. Remember that movie, The Big Short? I don't know if you've seen it or not, but that's what those guys were doing. Those guys had recognized that there was a bubble in the real estate market, that loans were going to not be able to be repaid, that the banks were going to have to take losses. They knew what that meant to the economy. They started shorting. They were actually shorting the mortgage banks, but they started shorting 2 years in advance. Now, what the movie didn't talk about or show you were all the thousands of other people that had made the same bets, but those bets you have to pay as you go to make those bets. You have to be able to absorb losses for a couple of years. And there were thousands of people who thought it was going to happen sooner than it did. and ran out of money before they could cash in. Talk about being upset. When you were absolutely right, you made the right call, but you didn't get the timing right and you lost your money anyway. That's a little rough. Anyway, I'm going to have to take a phone call here in a second. Board operator's actually a little slow here, but anyway, the show's almost over. If you've heard something, if you see something that you've got questions on, feel free to reach out with an email. I'll try to get back to you. If you're a client, I get back to you within 24 hours. I'll try to get back to you as quickly as I possibly can. And I do have I've got Daryl in Broadview Heights. Daryl, how you doing?
Hey, Bill. Doing great. How are you?
Oh, pretty good.
Great show. I just wanted to thank you and see if it's okay for me to remind your listeners about a small business opportunity with our company.
Sure, absolutely.
Yeah.
You got the floor.
Yeah, the website is Nutriskis.com. Nutriskis, Nutriskis.
And if they go there, they'll read the introductory thing. I think there's a little video that'll explain what the business opportunity is. Yep. Okay.
There's a little couple of minute video, and then the opportunity to look at a little bit longer video. And no obligation. It's free. Very low cost.
That sounds good.
People can work from their home.
That's a great idea. I know there are an awful lot of people that could probably use that today, especially if you're looking to build something on a part-time basis, and something that you might do during retirement might be kind of fun for you. Yeah, I like that. I think it's a great idea. So anyway, that's Nutriskis. Nutriskis.com.
Nutriskis.com, yeah.
All right. Well, hey, I hear the music. That means my show is actually over. Thanks for calling, and we'll talk to you again next week.
Oh, you're welcome. Yeah.
All right.
Have a great week.
Thanks. You too. And you've been listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. Go to my website, Bullington Capital, and I guess I better let the guy do the disclaimer. Have a good week, good investing, and good luck.
20 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.